And he finally stopped me. He said, Chris, well, how many of your clients are financially free where they don't worry about money? And even when I looked at the retired clients that I had, and even other people's clients, I could not find one example of some client that had actually not just retired, but was free. They didn't feel like they were going to worry about running out of money. So I said, none. Okay, Chris, how about this? How many of you guys as financial advisors are financially free, not off the commissions you're earning, but actually doing these mutual fund investments? And as I started to mentally look around my office, I realized, you know what? Even the guys who've been working there since the late 1970s still can't quit.
Welcome back to the Money Seed Podcast. Today, my guest is Chris Miles. Chris is an anti-financial advisor, a cash flow investor, and a fellow podcast host. Chris, welcome to the show.
Hey, pleasure to be here, Gabe.
Chris, first things first, what is an anti-financial advisor?
Yeah, it's someone who hates other financial advisors. No, I'm just kidding. No, I'm not going to be that negative. No, but pretty much it's really what it is somebody who says to do the opposite, right? Like, so it doesn't mean I'm against money, because I'm actually all for, making more money. But I am against traditional financial advice, especially financial planning that tells you to save everything, spend nothing, save it forever, and eventually someday you might have something. And my focus is more on kind of like the science says, right? Live your life now, not tomorrow. It's how we get actual benefits, like financial benefits today, right? How do we get that benefit today? Specifically, how to create passive income so that you become work optional before you're 60 or 70,000 years old.
Most people, when they think of investing, they think of just assets, right? Like, I'm buying a stock, I'm buying money in a mutual fund, I'm putting some money in gold or Bitcoin. Those assets typically don't produce a cash flow. And yet you're saying you want to invest for cash flow, right? So you can live today and not tomorrow. What does it mean to invest for cash flow?
Yeah, what it really means is that investment you do creates regular, in my opinion, at least, what I prefer to have is regular, stable, predictable income coming from it, right? I want to have money coming in. If it's not monthly, at least quarterly or annually, something like that, where money's coming in and you can kind of really count on that money. And you're right, like many people think about assets, and often we will talk to our clients about assets and things like that, like different types of real estate investing and things in the alternative space. But like we were talking before we went on the air about like business, for example. I mean, business is an active stream of income, but it can create what I call residual streams too, right? You can create residual streams of income through a business as well. Money that's coming in could be through memberships. It could be through intellectual property that's being sold online, especially with nowadays. I mean, heck, you can almost use AI and create money now. So there's a lot of ways to do that, even within the business realm. But specifically, when I talk about cash flow, it's how do we have more money coming in than what's going out, right? How do we improve that? So we can either, one, create more passive income, and or two, we can also find ways to reduce expenses without killing your lifestyle. We don't have to live on rice and beans and cut up those credit cards or whatever else you have to do to sacrifice and suffer and suck your entire life away. It really is something you can actually create on a month-to-month basis.
So, Chris, I think you yourself have an inspiring story of how you achieved financial freedom. Tell us a little bit more about how you discovered your source of passive income.
Yeah. So, my story kind of goes back, like with my dad. He was the typical hardworking, Depression era mentality saver, right? He was the guy that said, pay all your bills, your word is your bond, save every penny you've got. He was the kind of guy that would literally, I don't say this very often, but he would literally steal like Chinese plates and dishes and salt and pepper shakers from the Chinese restaurants if they didn't give him good service, because he's like, well, they should tip me. And so he's that kind of cheap, right? He's like, he buys Mrs. Buttersworth on sale because he could buy it by the case, that kind of thing. And so he was always telling me things growing up, like, we can't afford it. What do you think? Money grows on trees. I'm not made of money, And even worse, he would talk about how he would work until he died. And I knew I didn't want to live that life like any kid, right? You don't want to become like your parents. And so as I went into college and I was looking to create my own business, that was my intention. The first one that came up that I thought was interesting was becoming a financial advisor. Now, I didn't have any financial experience from that standpoint. I thought you had to qualify for it. I didn't realize that to be a financial advisor, all you have to do is pass a test with that at least a 70% and not have a criminal record, and you're hired, right? It's that easy. So I ended up getting hired doing that and had my own business and started to enjoy doing that. And personally, I was actually doing it because one, I wanted to help my dad at least get some sort of freedom because I didn't want him to work until he died because he would just think he would work himself to death. He'd already had strokes by his 40s and heart attacks and things like that. I wanted to do something different and free up his life, as well as benefit my life too. So several years after I was into that profession, then my dad called me up and said, Chris, when are you going to advise me? When are you going to become my financial advisor? So for the first time ever in my life, I got to see his finances. He was always tight-lipped about it. He never wanted to let you know he had any money at all. So I see his whole retirement portfolio. He'd been stuffing money in his 401k. He paid off all of his debt in 18 years. He was so proud of that. He did everything that Dave Ramsey would tell you to do. He would be the poster child that Dave Ramsey looked up to, right? So anyways, long story short, as I look at his finances, he says, Chris, I'm 61. Can I retire? And I said, if you retire today, you better hope you die in 5 years because that's when you'll run out of money. Okay, Chris, give me something else. I don't have it. Honestly, you did everything right. You did everything that I teach as a financial advisor. You did it right. If I try to put you in anything, I might be gambling your money away, and I don't want to do that. And so it left me in this really bad place. And as a result, what happened is, when the student's ready, the teacher appears. A few weeks later, I'm speaking with a guy that I actually hired to be a financial advisor in my company, and then end up leaving to go do real estate investing with his dad. And as I'm talking with him, he's talking about all the money and the income that they're making from that. And it was just 4 months after he left my company that he was doing that. And I thought, come on, that's too good to be true. And he finally stopped me. He said, Chris, well, how many of your clients are financially free where they don't worry about money? And even when I looked at the retired clients that I had and even other people's clients, I could not find one example of some client that had actually not just retired, but was free. They didn't feel like they were going to worry about running out of money. So I said, none. Okay, Chris, how about this? How many of you guys as financial advisors are financially free, not off the commissions you're earning, but actually doing these mutual fund investments? And as I started to mentally look around my office, I realized, you know what? Even the guys who have been working there since the late 1970s still can't quit. So I'm going to say none. And I was right. None of them were financially free. And so he said, well, there's your problem. And that got me down a path. I mean, it got me rereading Rich Dad, Poor Dad, but with new eyes, not from the financial advisor's eyes, where I thought somehow they were supporting financial advisors, which Kiyosaki does not. I was looking at it from more of an investor standpoint. And as a result, later that next year, I was actually able to be financially independent where I could quit. I was work optional. And I was 28 years old and wondering what the heck I'm going to do with my life. And eventually that's where people kept asking me, well, how'd you do it? And at first I didn't want to tell people what I did because, people were like, well, what are you doing right now? I was like, I sell drugs, because I didn't want to have to explain how all of a sudden I cracked the code, right? It really just became so easy, so apparent, and almost seemed accidental. It was so I just stumbled into it so much, right? But eventually I came out and started coaching people how to do the same thing, how to get people out of the rat race, how to improve their cash flow so they can get out of the rat race even faster than just putting their money to use and making passive income and passive investments.
And Chris, I want to get into the details of your real estate journey, but let's stick to this for a little bit about the financial planning, because you're one of those rare guests on this show where you have been a financial planner, you were in that industry, you have since left that industry, and you can look at it as an insider, but also with a critical eye. Maybe tell us a little bit more about what is it that our financial advisors, our traditional financial advisors, are not telling their clients?
The big thing that's going on is that financial advisors are not financial experts. They're financial salespeople. I mean, it's crazy to think that the licenses that's supposedly qualifies you to get, to give advice to your clients, really is just to pitch you products. I was thinking about this morning. I find that fascinating because, with an accountant, for example, right? Accountant makes sense. They know the tax codes. They help you with that. An attorney, they know the laws. They help you with that. Financial advisor doesn't mean that they can be any good at investing. They just literally offer you either mutual funds or insurances. And that's it. That's all they really offer. And so the problem is that as a financial advisor, not only am I a financial salesperson in a suit, but I was also going off of false assumptions, because I'm also telling you that the stock market returns 10 or 12% a year average, right? Which the S&P 500 has never done. In fact, I'll take that back. There was a 12-year period from 2009 to 2022, right? That period right there, yes, it got in the double digits. It averaged 14% actual return. But the long-term 30-year average, even right now, including that era, is only about 7.7%. That's it. It's not that impressive. Really is not. On top of that, the other issue is that, I remember like trying to run numbers for clients. And when we come up to inflation, I remember if I put in 3% even for inflation, which I know is lower than reality, it would get depressing for my clients, right? Because if I lower my return to the actual, like say 8%, which is still better than almost any mutual fund does on a long-term basis, I put 8% in there and then I put 3% inflation, all of a sudden it looks depressing. You haven't saved enough. Ironically, that's what the biggest complaint is right now, is that baby boomers haven't saved enough, but they're blaming the baby boomers versus saying, wait, these baby boomers were really good savers, saving a lot of their income, but they're still not free. What's going on, right? They don't do that. They blame the savers, even the savers, even the good savers. They all call them spenders. But the truth is, most people that qualify for 401k actually save in a 401k. And even with the match, it's still not enough. And so all these faulty numbers and assumptions, it's overpromise and underdeliver. And yet people still keep coming back for more. That's the problem. That's the big issue I have with financial advising, is that no matter how you run the numbers, if you run them based on reality, you'll find out that it just doesn't work. Whatever you save per year is pretty much what you'll live on after inflation per year. You max fund your 401k with $20,000 a year, you'll be living on the equivalent of about $20,000 a year. That's an issue. It's all about accumulation mentality, right? Accumulating a bunch of money and then living on less than the interest. The recommendation now is 3% a year that you live on. That's just not enough. That means you save $2 million to live on $60,000 a year. $1 million, you live on $30,000 a year. I mean, you're in California. You can't live on $30,000 a year, right? It's just impossible. So of course, people won't vote out Social Security because they need it, because no matter how good of a saver they are, they still will be broke. That's why you need another option.
Let's go back to real estate, because I think that was your other option, right? So how did you tell us about your first deal and how you were able to scale?
Yeah, my first deal, I started doing more active investing, which, for the right person, that's good. For me, it wasn't that great. So I did it. And I remember I took my starter home, I sold it to an investor, then I leased it back and then subleased it to a renter, right? So I basically stripped all the equity out by selling to an investor at full appraisal, and then leased it back and then turned around and sublet it to somebody else. So I kind of got creative with my first deal. Negative cash flow, but I thought, who cares? I got all the equity out. I can invest it in other places, like in the actual real passive investments, like funds and things like that. But the problem is, again, I was negative cash flow, right? And that didn't ever get much better, especially when the recession hit just about a year and a half or so later after I did that. And so I started doing deals like that. I even started getting more into like wanting to flip properties because, even if I was positive cash flow, I mean, think about it. I mean, you hear people saying, oh, I made $300 per door, right? $300 a month. That's not very sexy. What does sound sexy when someone says, I flipped a property and made $100,000. And so I started going that, and I started doing the math. I thought, well, I could flip a $100,000 house maybe. And even if it appreciates 10%, I make $10,000. But what if it's a $500,000 house? And then it appreciates 10%, then I make $50,000. So I should buy bigger houses, which does not work, right? Because when there's a recession, when it's above the median price in that area, that's when you get hit the worst. People that have to downsize will downsize into those lower properties, or at least the average type of properties. I didn't do that. And so I went from really being financially independent to all of a sudden over $1 million in debt, especially because I came out to do business. I cut off some income streams beforehand. And the next thing I know, we're hurting, especially where we were focusing on people that were flippers in the real estate game. So eventually I did dig out of that hole, but it was a long journey. I didn't file for bankruptcy, but man, it would have been so much easier if I had. It would have saved me $1 million of debt to pay off. That's for sure. So anyways, I was able to battle out of that and get back there in 2016. But I'll tell you, like, the real estate game, active is good for some people, but just don't be delusional believing that it's somehow a passive type of business, right? Because if you do active real estate investing where you're wholesaling or you're flipping properties or things like that, it's a legitimate business. You are taking time out of your schedule. You are using a lot of energy, a lot of knowledge. Even if you leverage teams, it's a business, not a passive investment. So do not ever let any of those people tell you, oh yeah, wholesaling is passive. It's not, right? It's a very active thing. And for the right person, you can make a lot of money doing it. But if you're looking for passive, that's where I'd rather invest with the investors, put my money with them, whether I'm lending them money, whether I'm partnering in deals with them or whatever it might be. That's what I like to do today.
Yeah, well said. And I've had a lot of syndicators as guests on this show. and that's what they specialize in, right? Is to find investors, and then they do pretty much all the work.
Yeah.
Which is a great way to get started in real estate if somebody's not very familiar or not confident with getting in themselves. But what other options are there? I mean, real estate is a very well-proven, sort of well-beaten path. A lot of people who are wealthy got there through real estate. What other options do people have if they want to invest for cash flow?
Yeah, I mean, beyond just buying your own rental property, right, or having somebody manage a rental property like a turnkey investment property, you mentioned syndications is good. There's funds where you can do debt funds and things of that nature where you get paid contractual return. You could do short-term hard money lending where you're literally lending that money to the investor that's doing the investments. Even outside the real estate space, if you're going outside, even like self-storage and apartments and all that, commercial and all that kind of stuff. I mean, there's even things like oil and gas. There's an oil and gas space that you can get into as well. Now, you got to be careful. Most oil and gas investments are not very good passive investments. They're more growth oriented. So they're not cash flow oriented, right? And the difference is this, like growth means there might be a big payoff 3, 5, 10 years down the road, right? But there's no real income along the way. Cash flowing investments mean that you get paid income, even means there's less or nothing on the back end, but at least you get paid along the way. That's my personal preference. I like those. One investment I'm in, for example, is invest in more mineral rights. So you get paid two ways. You get paid from the company that leases the land from you. So oil companies, believe it or not, actually don't want to own the land. They just want to drill the heck out of it, do their business, and then just pay a lease to you and move on, right? And just keep drilling until they can't drill anymore, right? And that could be decades before that ever happens. So with mineral rights, you can get paid from the lease on the land, and you get paid royalties from the drilling, the production they do, all production. So that's not just oil and gas, because one of the natural byproducts of oil and gas, of the actual liquid, right? The byproduct is natural gas, which is a green energy, clean gas that comes off the top. It's like the steam off of water, right? Mm-hmm. So that comes off too. You can get paid on all of that. So you can actually kind of double dip on that investment. That's a great one there. One of my favorite ones, even though it's real estate, it's not one that I'm doing actively. I'm actually partnering with a couple guys that are doing raw land, and raw land's a very different animal because really you're just turning around and seller financing it back to other people, whether they be investors or just consuming owners or whatever it might be. That's kind of been fun. I mean, I get probably the best returns off of that, even over my oil and gas investments that I have, or turnkey properties or anything else. So there's a lot of different ways you can go. Franchises is another option too. There's even syndications where they go into business, like car washes, right? You can go into those kind of deals. I would just issue caution, like anything. Everything always has risk, right? Definitely on the business side, I tend to put it more in the speculative category. If I'm going to invest in business, I much rather trust in my business versus somebody else's. It doesn't mean it's not a good one, but it does mean that I'm a little bit more careful because I know there's a little bit more higher risk with some variables and things that can happen with economies and things like that.
Tell me a little bit more about that oil and gas deal that you mentioned. How did you come across it? Because that doesn't sound like your typical ordinary investment.
It's not. Most oil investments you see are more what's called working interest, which can be great from a tax standpoint, right? But you really are speculating, This one, it's not easy to come by. I mean, there are some people out there, but they really aren't that as common as what you would see of those typical drilling deals. But if you do look at mineral rights, there are some mineral rights syndications out there for accredited investors and such. And you just want to make sure you find a good reputable one. It can be the oil industry is probably one of the worst industries I've seen for not being reputable. So you do need to be careful.
And what type of returns can someone expect? Like if someone joins, you mentioned whether it's a storage unit or a car wash or oil and gas, somebody joins a syndication, what kind of returns would you say are good and what should people expect?
Yeah, I would expect, most of those syndications will pay at least I'm not talking about the oil and gas one, separate of the mineral rights one, but with most syndications, usually you'll see at least a good 7 or 8%, what's called a preferred return, which is kind of like their base debt payment to you. And that's nice to get that regular payment. But I like to look for double digits. I like 10% plus is what I typically look for. I would be careful though, because, and you've probably seen this too, in the syndication space, there are a lot of people, it almost seems like a dime a dozen when you see they give you the pro formas, right? They'll show you here's what they can make. Our internal rate of return is expected to be between 15 and 18% a year, right? It's almost like they just took a stamp and just stamped the same thing. And some of them literally do that. I've actually seen deals that I've come across. I'm like, wait a minute, this one legitimately looks like another deal that's not theirs, and they were a scam, right? So you do have to be careful. But and again, don't think that lower returns means lower risk. That's not always the case. Just like high risk doesn't always mean higher returns either. But I would say this: if you're looking for good deals, look for an investor that's been around the block, someone who's been around. I would say longer than at least, and I'm saying minimum 10 or 15 years, like where they've been through at least a full market cycle. They've been through the last recession. Maybe they got their teeth kicked in the last recession, but they learned from it, gained some wisdom, and now they're stronger for it when they come back around this other side now. Those are the people I like to invest with when I do syndications. So I pay more attention to the who I'm investing with more than the what I'm investing in, or or whatever type of deal it is. So be very careful with that. But I mean, I'll tell you, like expected returns, like on the oil and gas one, I mean, they generally target 10 to 15%, but it can vary. Like for example, the company I've been using, they'll have like a deal every month, right? Always some new project, a different land parcel that they're using. And like my project, when I got in, it did like 8% last year, right? It was one of the lowest performing ones they have in their entire portfolio. It did 8%. The month later, there was a better deal that I almost kind of wish I had backed out of my other one, but I was already invested in the other one. The one that came out the next month, that one, which many of my clients invested in, actually did 35% last year. So that's the thing. There can be a range. It can vary, right? You just never know. But that's why it's good to be diversified. That's why you don't try to throw all your eggs in that one basket. In fact, even I have to tell my clients, don't throw all your eggs in that, that mineral rights basket, because the truth is you never know what could happen. There could be good markets, there can be bad markets, but ultimately make sure, again, you know who you're investing with and what kind of experience they have and whether they're the real deal or not.
And Chris, with many real estate syndications in particular, that it's not a consistent cash flow, right? So for example, you might get a little bit each month from the rent, and then there's a major, like a refinancing event 5 years down the line, or they sell the property in 5 years. That's when you get a big lump sum. Do you recommend any type of syndications where you have a more consistent cash flow and not a lumpy one?
Lately I've been talking to a lot of our VIP clients or one-on-one clients. I've been talking to them more about looking more into funds, things that diversify their own risk within it. So maybe they're investing in multiple syndications, or maybe they're just a debt fund where you're literally loaning them the money. They do their own active investing and you get paid just a set return. I'll tell you, the syndicated space right now is a little bit scary. And it has been for the last year. Even experienced people are experiencing some stress. They're really seen a stress test happening with some of their deals, especially the ones that say, hey, and these are like the standard type of ones you see with apartments, for example, right? Is, here's the deal. We're going to have some cash flow coming in. We're going to do some value add, as they call it, right? They're going to renovate the property, try to make it better so it performs better. And then a year 2 or year 3, we're going to refinance it. And what we're seeing across the board is that nobody can really refinance right now. So they are literally relying solely upon not only just the rents, but then their interest rates rising on them because they got a variable rate loan, a short-term loan on that deal. So people are running into some big issues because their numbers just didn't factor that in. And so for my clients lately, a lot of them are kind of avoiding the typical standard refinance in 2 or 3 years type of deal, and kind of waiting till things get a little bit better on the interest rate side before that becomes the case. Because for the most part, they aren't budgeting in higher rates than what they're currently looking at. And many of them, when they did the deals initially, even in the last year, were saying, oh, I can get a rate at 4% or 5%. And no, you can't, not anymore.
Tell me a little bit more about your clients. What does your typical client look like?
Our typical client, usually they make at least, $150,000, $200,000 a year. They've got usually at least $150,000 to do something with. And that's the thing, is that the big advice I give everybody, right, is get lean, get liquid, and get out. Get lean means, make sure you really try to get your expenses under control. Like you can still live a good standard of life, but if you start watching your money, start tracking it, like I tell people, use mint.com, for example, use their app, use that to track your money and really watch where your money's going. You start to realize you probably have money leaking in different places. So if you can reduce those expenses without reducing your lifestyle, and that gets you just easier, makes it easier for you to get out of the rat race faster, right? You do that on one end. Then get liquid means make sure you have your cash available. Get your money out of prison. So many times, if you think about it, every financial advisor or every financial pundit, for that matter, other than what you're hearing on this show right now, They'll typically tell you, lock up your money in those IRAs, their 401ks, leave it in there forever. Let it, let that miracle of compound interest work for you, right? And then also pay off your house. So lock up your money again in really a 0% returning asset. Throw your money into your house so the bank has your money, but you don't, right? You just have this illiquid asset of your house, and the bank has all your cash, your liquid cash. They're the ones making money off of you. So turn the tables like the bank does, but do it in your favor, right? Get that money out. Now, it may or may not mean you get money out of their house equity, because there's better ways to do it sometimes with fixed rate loans versus going for HELOCs right now. Like home equity line of credit with variable interest rates can be really risky right now. But when you've got money locked up in IRAs or maybe old company 401ks, can you get that money out? How about just sitting around in savings? Do you have crappy life insurance plans, right? That's got cash value in it, like certain types of whole life or universal life? Could we use that to invest? Really just getting that money out and get it out, right? Get it out into those cash flowing investments. And so that's what we look for. We look for those people that are saying, you know what, I've got assets. Maybe I even have some net worth, but you know what, it's worthless. They're almost like the Dave Ramsey poster child that says, I was saving up all my money, I've been paying off my debt, yet I'm still not any more free. I'm stuck, right? I had a guy actually out in California that he was retired. He just retired from the military. He was the 4th highest ranking general in the military in California state. And he had $1 million saved up in his retirement plan. He goes to his financial advisor. He says, all right, well, you got $1 million. You can live on $30,000 a year. That's what you should do for the rest of your life, right? So you don't run out of money. Well, Dan didn't like that. He said, well, forget that. I need to find another way. Then we got him in other alternative investments, right? So he was looking at things like rentals, even like duplexes. He got a few of those, like turnkey rentals, so he didn't have to manage it. He got into some syndications. He did some funds. He did some mineral rights type stuff. And at the end of the day, he was averaging about 11,000 or about 130,000 a year. 100,000 more is what a financial advisor said. And again, you don't have to have $1 million to do that, but that's the difference, right? It's always about what kind of income can actually be paid for the money you have. How do you get your money working harder for you so you don't have to work so hard for it? And that's really what we teach at Money Ripples. Yeah,
and I think you touched upon something really important, is because I feel like the advisor who told your friend to say you can take out 3% a year, right? 30,000 a year. It seems like that advice is not trying to maximize his outcome. It's trying to minimize the downside. It's like that's like we're trying to minimize the chances of a worst case scenario. Whereas it sounds like what you're advising him to do is to maximize his upside.
Yeah, it's a very different, you're right. That's a very different mentality. It's, to use financial advisor terms, we always talk about the golden goose, right? Don't you dare touch that 401k or that IRA, because that's your golden goose. Don't kill it. But really what happens when you get in retirement is like, how slowly can we eat the goose, right? Can we just take a little piece off of here, a little piece off of there, right? And just keep killing that goose until it's pretty much emaciated and dead by the time you die, right? That's really what financial advisors are having you do. It's how do I not run out of money? And you're using principal and interest, where our side, we actually want to have that goose lay fatter golden eggs. And so we're literally trying to have that produce income. So like the difference with him is, instead of him slowly pulling off that money, because he knows in bonds and certain types of money markets, a conservative portfolio is not going to return him very well, especially with inflation. Instead we're getting him the income, but we're still not touching the $1 million, right? The $1 million is still intact. It's still producing for him for life. I think that's the big difference right there. It's not where they're pulling off a little bit of that principal till you get down to zero. It's how do we get that $1 million to keep paying you forever? That's the goal.
Yeah. And I think that is the correct way to look at it, is how do I maximize what I get out of that $1 million, right? Not how do I make it last the longest by taking out the least each year. So that's a very, very different way to look at it, which is really cool. So tell me a little bit more about the Money Ripples podcast.
Yeah, we talk about this kind of stuff, right? I mean, this is the fun stuff to talk about, It's really about, like I said, how to get your money work for you so you don't have to work so hard for your money. And so, I'll talk about everything. I mean, I've talked about like the myth of the match, the 401k lie, how the match actually doesn't give you 50 or 100% return. We talk about, even just my experience as a financial advisor and what had to be debunked in my own mind so that I could move into this other world, right? It's almost like the Matrix. I had to take the red pill, and it was a whole nother world than what I was taught as a financial advisor. It was a whole different experience. So we really talk about that. We bring on guests as well, like you do, to talk about various types of investing, or even things that might help you personally too. Because the truth is this, that my goal, I mean, I don't have to do this anymore. I'm financially independent. I'm fine, but I love teaching, right? And that's the big thing. And the big thing about Money Ripples is that we're here to create a ripple effect in people's lives. That's why I can't quit, because I believe that God's blessed me with this kind of rare opportunity. What am I going to do with my resources? How can I use it to bless more lives? How can I use it through my business, Money Ripples, to help more people? And that's really what we do on our show. Is it's not just about getting you rich, it's helping you create a richer life, because as you're blessed financially, you have a greater capacity to bless the lives of those around you, not just your family, but even your community, the country, and ultimately across the world. So we're really here to liberate people.
How many different people you have on your team, and are you actively taking on new clients?
Yeah, we definitely take new clients for sure. We even do if you ever heard of strategy, infinite banking, we even do that. We actually brought that in-house because even when I had friends doing it, they still did a crappy job because they were just trying to make a commission. So we ended up bringing that in-house as well. So we really just do those two things for our clients: is, create the infinite banking strategy where you can actually get your money to pay you twice. And then also one-on-one consulting, helping people figure out, what are the different avenues they can take their money to get it to generate some passive income, and that kind of thing.
Very cool. I first heard the term infinite banking less than a year ago, right? Like I'm in my mid 40s, and the first time I ever heard that phrase was about, like maybe 8-9 months ago. And since then, you're probably the 7th or 8th guest who's come on the show and said, we do infinite banking. And I've been really looking into it, and it really is quite amazing what that vehicle can do.
It can be. It really can be. Unfortunately, most people that talk about infinite banking, it's a piece of crap. And this is from my investor perspective, right? Funny thing is, of course, because I was a financial advisor, I didn't even hear about it either until after I quit being a financial advisor and I started learning from these guys in real estate space. People were talking about it, but they were talking about like this long-term thing you save up for, like this supplemental retirement. What I learned though is that if you can cut the commissions back enough, which just even the infinite banking guys don't want to do, if you cut those insurance commissions back enough, you can actually have a lot of cash available from day one that you can then use to invest and get paid in two places at the same time. So it does have to be done right. Otherwise, that's why you have guys like Dave Ramsey and Susie Orman rip on infinite banking, because there's so many guys out there talking about it. But again, they think more about their pocketbooks and they're not investors, right? And so just be warned, like there's good stuff out there and there's bad stuff. And that's why you'll see mixed reviews when you try to research it.
That's a great topic. Let me stay on that for a little bit. So when somebody goes to talk to their, finance individual and they say, hey, look, here's an infinite banking policy, what are some of the 2 or 3 things they should check, like they should look out for? What are the red flags?
The biggest red flag, it's hard to see sometimes, but the biggest thing you should see is how much do you have in cash out of the first year. Now, that's not everything, because, for example, there's one company I can use like Mass Mutual. You can put, say, $10,000 into a policy that year, and you'll have $9,000 in there that you can use and leverage. But they make you wait a year. And then 2, they also charge you more costs over the next several years. So the funny thing is Mass Mutual has this great one that year 1 looks awesome, but they have another one that's more vanilla that actually beats it after 5 years. So what you want to look for is not just the year 1. Like I don't want to see more than 25% of costs come out in year 1 when you put money in. That's the most expensive year for whole life, just so you know. So usually it has to pay for itself by year 4. That's what I like to see. Other things is by year, usually year 6, I want to have as much in cash as what I've paid into it. So if I'm paying $10,000 a year, I want to see at least $60,000 in cash by year 6, and then surpassing beyond that point. So it's hard to tell. The best way to do it, though, I've told people, is if you're not sure, because especially when they get some financial guys out there, insurance guys saying, here's some crazy random numbers of so many cents you could put in, just have somebody run apples to apples. And our team's more than willing to do that. If you go to moneyripples.com, you can even reach out to us, say, hey, somebody sent us some numbers. Can you take a look at it, see if it's good? Because it's good. We'll tell you, say, look, that's what we would do. Looks great. Go for it. But if it's not, we'll also be honest and tell you too.
Awesome. All right, Chris, one last question before we wrap it up is, if somebody is, let's say, in their 40s and they've done everything that a traditional financial advisor told them, right? They saved a lot of money. They pumped all their money into their 401ks. They're more than halfway to paying off their house, but they're really not sure if they're ready for retirement. What advice would you have for them?
That's good. You're at that point, especially if you're 40s, not ready for retirement. The best thing to do is really start to unlearn what you've been taught, right? Unlearn what you've been taught that's supposed to be right. Everything that your colleagues, your coworkers, or your friends, or your brother-in-law is doing, for the most part, that's probably going to be crap. The best thing you do is start listening to people and learning from people that have been there, done that, and still doing it today. So I think the best way is really get yourself educated, get that foundation, because I'll tell you that I think, in my opinion, at least, the strategy is the easiest thing to do, right? That's the easy part. The hardest part is breaking past that mindset, thinking that you have to do it the way that everybody else is, right? I always laugh when someone says, well, I'm a conservative investor, right? Like, oh, I don't do anything outside of mutual funds. I'm a conservative investor. And I look at them and say, no, you're risky. Like, I wouldn't dare gamble my money in the stock market right now. That's the dumbest thing to do. I was like, no, I wouldn't do that at all. That's horrible. Instead, you're not a conservative investor because you're already gambling your money in the stock market. What you actually are is a comfortable saver. You're a comfortable saver trying to do what the status quo has been. But look at the evidence. Average 401k balance right now, even for a retiree, is just under $100,000. That's with people that have been saving. There's also Fidelity has about 48 million. What do you call it? Not clients, but 48 million users.
Right? Yeah, users. Yeah.
Of those 48 million, 299,000 as of 2022 were 401k millionaires. Only 299,000. There's a lot more baby boomers than that, right? There's a lot more people I know saving.
Did I hear the math right? So that's less than 10%.
Oh yeah, it's less than 1%. It's horrible because remember it's over 40. It's like 48 million. But there's only 299,000. Right?
Oh, that's right. Yeah. So 4 million would be 10%, and this is even less than 400,000. So it's less than 1%.
Exactly.
Wow, that's
brutal. The stats. Also, those target date retirement funds that they have in Fidelity, I ran the numbers, found out they're actually about 2.5% below the stock market average. So if the market average is say 7.7%, right? That means you're only earning about 5% in those, which is part of the reason why people aren't retiring as millionaires. So, I mean, I kind of digress a little bit from what we're saying, but if you're in your 40s, the best thing to do is to stop and assess and look around, right? And in fact, I would actually recommend if you want to see like what's possible in your situation outside of the traditional realm, you actually go to moneyripples.com. We actually have a passive income calculator on there that you can fill out. It'll tell you, like, even just a conservative 10% return on investments with the resources that you have, what kind of returns could you make, like in passive income in the next 12 months? So that's a great way to kind of assess to see where your situation is. Because I've had so many people. I mean, I had a woman in Arizona that she's like, yeah, she's 50s, right? She was single in her 50s. And she's like, yeah, I just don't think I'll ever retire. I'd like to do it in 10 years if possible. I said, well, what do you have? She had $250,000 in mutual funds and savings accounts. I said, all right, well, what do you need to survive each month? Like, what do you need to be financially independent? She said $2,000 a month. So she's living very lean, right? I said, and you want to retire in 10 years? Yeah, I hope I can do it. The financial advisor says it's going to be a long shot. I said, here's what's crazy. 250,000, you make 10%. That's 25,000 a year or just over $2,000 a month.
Right.
She's like, come on, you're pulling my leg. I'm like, no, it's math. It's not hard. It's not hard to figure out. This is what we do. And it blew her mind. Like, it shook her world so much. It took her days to even just consider it would actually be a real option, So that's the thing, is that there's probably potential that you may not be seeing right now that can reverse if you just have a different way of looking at things.
Very well said. Chris, what is the best way for people to reach you?
Yeah, you can go to moneyripples.com, or you can follow us on our podcast, the Money Ripples podcast. You can find on iTunes or Apple Podcast or on YouTube as well.
Excellent. I'll put those links into the show notes. Chris Miles, thank you very much for joining us.
Such a pleasure. Thank you.
Hey, thanks for joining us for another episode of the Money Seed Podcast. Please remember to click like and subscribe. It really helps spread the message to other investors, and it helps attract new viewers to the show. We appreciate your support. Thanks very much.